Hi everyone, what's up? Welcome back to my tutorial channel. It's Daniel here, and today we are going to talk about the Modigliani and Miller propositions. In this lesson, I'm going to first introduce some new definition. Then I'm going to talk about the three propositions when we have tax and when we don't have tax. And finally, I'm going to give you some practice. So first, some new definition. We have two types of firms, the unlevered firms and the levered firms. Unlevered firms are the firms that issue no debt, and for those firms, equity is said to be unlevered. The second type is levered firms. They issue both debt and equity. Here, equity is said to be levered. A new concept is market value balance sheet. This one is actually similar to the accountant balance sheet. They show two things. The first one is the current market values of different types of assets. The second one is intangible assets such as goodwill, reputation, and human capital. And we have some examples of these assets. For intangible assets, it could be cash, petty cash, inventory, buildings, or accounts receivable. Tangible assets might be intellectual property, human capital, total market values of firms' assets. Debts can be either short-term debts, long-term debts, convertible bond. Equity might be either common stock, preferred stock, warrants, retained earnings, or total market values of firm securities. Alright, now we got some new formulas. However, some of these I think we have seen in the lecture of cost of capital. Here the debt to equity ratio, assuming only one type of debt securities involved, is D over E, where D is debt and E is equity. D is the value of debt and E is the value of equity. The total market values, assuming no other securities other than debt and equity involved, is D plus E. So A is basically debt plus equity. The debt to value ratio is D over D plus E. Remember, D plus E is the total market value, so D over D plus E is the ratio debt to value. And this ratio is equal to D over E, the whole thing over D over E plus 1. We also have some notation here. We can use the total market value of assets as A. And we got RA, RD, RE are the expected returns of asset, debt, and equity respectively. This is from the lecture of cost of capital. Now, we have a new concept that is perfect capital market. So here, a perfect capital market is basically a market that satisfies the following three conditions. The first one, investors and firms can trade the same set of securities at competitive market price equal to the present value of the respective securities' future cash flows. Number two, there are no taxes, transaction costs, and insurance costs associated security trading. This one means that in case of bankruptcy, if a firm goes bankrupt, the firm's asset can be sold at their economic values without legal and administration costs. So that is the second condition. The third condition is a firm's financing decision do not change the cash flow generated by its investment, nor do they reveal new information to them. And let's talk about Modigliani and Miller proposition. Here we can use the abbreviation for this set of proposition as MM, double M. So we have here three propositions. The first one is the MM proposition 1 without tax. Then the MM proposition 2 without tax, and we have one proposition for the case of taxes involved. So let's work through them one by one. The first proposition, the MM proposition 1 with tax. This proposition says that in the perfect capital market, total value of assets is equal to the value of debt plus value of equity. This proposition indicates that two firms with the same assets but different capital structures should have the same total values of securities. If the above proposition is violated, then there is an opportunity for buying low and selling high. And we have financial leverage. The financial leverage of a firm magnifies shareholders' profits and losses. The way they magnifies is like the return of equity is calculated by the net income over equity. The earning per shares is net income over number of shares. Okay. Alright, so now let's take a look at an example of financial leverage. Now we consider a case when a firm has the total value of assets as A is equal to $100,000. The number of shares outstanding is 2,000. Corporate tax rate here is 0%. Earnings before interest and taxes is 20,000. Calculate the returns of equity and earning per shares. Here the return of equity is net income over the total value of asset. The net income is not given. However, since we have no debt mentioned in the question and the tax rate is 0%, so the earning before interest and taxes EBIT is actually the net income in this case. I repeat, there is no debt mentioned in the question, so there's no taxes and no interest. Also because corporate taxes rate is 0%, so there's no taxes. So the earning before interest and taxes EBIT is actually net value in this case. So the return of equity here is net income 20,000 over total value assets, which is 100,000. So the return of equity is 20%. Next, the earning per shares is net value over the number of shares outstanding. Here the net value is EBIT in this case. So we got 20,000 over 2,000, then earning per share is 10. Now we are going to modify the situation a little bit. We assume that we are issuing 10,000 debt into this firm with 5% interest rate. That means we might borrow money somewhere to invest into this. So we got 10,000 debt and 5% interest rate. And the tax rate here is 0%. So now we have to recapitalize the capital structures. Here we got debt is 10,000, equity is total assets subtract debt. So we got 90,000 for equity. After recapitalizing, the number of share repurchase is debt over earning per share. We got 10,000 of debt over 10 of earning per share. We got 1,000. So here, among the number of shares outstanding 2,000, we got 1,000 repurchased. So the number of shares is 2,000 subtract 1,000. So the new number of shares is 1,000. And since we have debt, so we have to pay for interest. And the interest on this debt is 10,000 times 0.05, which is 500. So now the net income have been changed. We take the earning before interest and taxes 20,000 subtract the interest of debt of 500 when we got 19,500. So now the rate of return is net income, the new net income over the total value assets, which is 19,500 over 100,000. We got 19.5% for the rate of return of equity. And the earning per share now has been changed. We got 19 1,500 over the new number of shares, which is 1,000. We got 19.5. So we see that. So from here we have a conclusion. In a perfect capital market, in a perfect capital asset, leverage has no effects on the firm value, but it has impact on the firm's returns on equity and also earning per share. We see that the value of the total value of assets is still 100,000, but the return of equity and the earning per share both change. See that? So our conclusion is in a perfect capital asset, leverage has no effect on firm value, but it has impact on the firm's return on equity and also earning per share. All right. So that was the first proposition. Now we look at the second proposition in case of no tax. The second proposition without tax say that asset is equal to equity plus debt. The unlevered cost of capital is RU is equal to D over D plus E times RD plus E over D plus E times RE. Here we assume no tax involved. So there's no corporate tax rate here. And this formula we have seen in the lecture of cost of capital. And from this equation that is marked by star, if you withdraw RE, we got RE is equal to D over E plus 1, the whole thing times the rate of unlevered cost capital, subtract D over E times the return, expected return of debt. And the unlevered beta of capital is beta U is equal to D over D plus E times beta D plus E over E plus D times beta E. And withdraw beta E from here, we got beta E is beta U plus D over E times beta U subtract beta D. These formula we have seen in the cost of capital lecture, right? Now the third proposition is the MM proposition 1 with tax. Here's how tax is calculated. Tax is interest before earning before interest and taxes subtract interest times the tax rate. Earning before interest and taxes subtract interest is earning before tax. So we take earning before taxes times tax rate to get the tax value. And the net income is basically the earnings after interest and taxes. So net income here is earning before interest and taxes subtract interest and subtract tax. We have a new concept, interest tax shield is interest payment times corporate tax rate. The value of the firm, here the value of the firm VL is equal to VU plus interest tax shield. The weighted average cost of capital is RWACC is equal to E over D plus E times RE plus D over D plus E times 1 minus tau C times RD, and is equal to pre-tax WACC subtract D over D plus E times tau C times RD. Here remember only with debt we have taxes and interest. So we got 1 subtract tau C time with the portion of D over D plus E times RD. See that? This formula we have seen in cost of capital. Alright, so that was it for today. The following exercises are just some core examples. In order to have the best practice, you should find and work on more exercises that relate to this topic. So now we are going to look at some basic problem. Which of the following statement is or true? Number 1, the relative proportion of equity, debt, and other securities such as preferred stocks constitute a firm's capital structures. Number 2, the sum of the book value of a firm equity and debt equal to the book value of all assets of the firms. Number 3, with perfect capital markets, the cost of issuing equity is 0. So for this one, 3 is the correct answer because when we look at the first statement, the relative proportion of equity debts and other securities such as reference stock constitute a firm capital structure. This is wrong. We don't really care about the proportion. Number 2, the sum of book value of a firm equity and debt equal to the book value of all assets of the same firm. We care about the value, not the book value. So this is incorrect. Number 3, with perfect capital market, the cost of issuing equity is 0. Remember, with a perfect capital market, the transition cost and administration cost is 0. So this is the cost of issuing equity should be 0. So 3 is correct. Alright, now look at question number 2. Which of the following statement is or true? First, the equity of unlevered firm is riskless. This is wrong. Any firm should have risk, no matter like a big risk or a small risk. Any firm, any investment, we have risk. So 1 is untrue. Number 2, assuming perfect capital market, the expected return of equity of a level firm varies with its debt to value ratio in a linear manner is not a linear manner. So this is wrong. Number 3, Modigliani Miller proposition 1 says that assuming perfect capital market, firms with identical assets but different amount of debt have the same value. This is true. The Modigliani Miller proposition 1 say that assuming with perfect capital market, firms with identical asset but different capital structure should have the same value. And here amount debt is like a part of capital structure. So 3 is correct. So here only 3 is correct. Question number 3. DSD is an unlevered firm with a current market value of 120 millions and a beta of 1.5 is decided to repurchase shares by issuing 40 million of risk-free debt, assuming no tax, and find a beta of DSD equity after the share repurchase. Before we do anything, I want you to pay attention to the risk-free debt. By this keyword, risk-free debt, that means beta of debt is 0. Mark it, you can take a note, write down. For risk-free debt, beta of debt is 0, okay? So here, what do we have in here? We got A is 120, beta of U is 1.50. We got 40 million is D. Assuming no tax, so there's no tax involved. Find the beta of equity, so we have to find beta E, okay? So here we follow the formula beta U is equal to E over E plus D times beta E plus D over E plus D times beta D. Here there's no tax involved, so we don't need 1 minus tau C in the second terms, okay? And here because we have a risk-free debt, so beta D is actually 0. So the second term is cancelled out just because beta D is 0. So we got beta U is E over E plus D times beta E. Beta U is of course 1.5. E is 80 because here we have 120 is A, 40 is D. So take 120 subtract 40. We got E is 80. E plus D here is A, which is 120. And beta E is not given. So now we have a linear equation, right? This is a simple equation of one variable. Solve for beta E. We got beta E here is 2.25. See that? So for this one, we basically use the proposition 2 of no tax. Next, the market value balance sheets of a company consists of 40 in debt and 80 in equity. The beta of company debt and equity are 0.3 and 1.65 respectively. The company's weighted average cost of capital is 14%. The company pays no corporate tax. So here what do we have? We got 40 is D, 80 is E, so A should be 120. Right, beta of D is 0.3, beta of E is 1.65, and beta U weighted RU is 14%. RU is the expected rate of return of cost of capital. And we have no tax, no tau C. Tau C is 0. Which of the following statement is or true? First, if the company issue an additional equity of 10 to retire 10 of debt, the company cost of capital will increase by 14.6. This violated with the proposition 2 of because here when we change the capital structures, and if we change the capital structures, and if the value of the total assets is the same, then we have the cost of capital, they should have the same value. So the company cost of capital should not be changed. So this is wrong. I repeat, this is by the second proposition of So the same two firms with the same total value asset with different capital structure should have the same value. So there's no increase in here. So 1 is incorrect. Now if we look at number 2, if a proposed new project has a beta of 1.05, the project is riskier than the company existing business. We have to verify this by calculating the new beta. And riskier here, the new project is riskier if the new beta is less than this beta. But here, if we calculate the beta using the formula, we got the beta should be 1.2. 1.2. The old project is 1.2. The new project is 1.05. So that means the new project is actually safer. The new project is safer than the old projects, not riskier. I repeat, 1.05 is the beta of the new project. For the old project, which you have to follow the formula of beta U, which is 40 over 120 times 0.3 plus 80 over 120 times 1.65. We got 1.2 for the beta of the old project. So the new project has lower beta, which means lower risk. Lower risk, so it should be safer. So number 2 is wrong, is incorrect. Now for number 3, if the risk-free interest rate is 8%, then the expected market risk premium is 5%. This is correct. So we got 3 is correct. The risk-free interest rate is 8%. That means we got R of F is 8%. This will go back to the lecture of the first 2 lectures that I posted. So in order to know why we got the risk premium is 5%, please rewatch my video of risk-free interest rate and market risk premium. Alright, so number 3 is correct. Number 3 is correct. Alright, so that's it for today. After you finish this lesson, I expect you to understand the proposition, know how to calculate the effect from changes in capital structure on a company overall value, equity, beta, cost of capital, and so on, assuming that the proposition are hold. Alright, so thanks so much for watching my video. I hope you guys find my video helpful, and see you next week. Bye-bye.